Right now, Americans are carrying over $1 trillion in credit card debt. People are losing their jobs, and even when wages go up, they're not keeping up with inflation. Honestly, by a lot of metrics right now, we're in a kind of unofficial recession. So you'd think the stock market would be crashing right now. But actually, the market is at all-time highs. The S&P 500 just hit a record high, and the Nasdaq did too. Most people are trying to explain what's going on by either saying the economy is strong, there's nothing to worry about, or the market is just rigged or broken. But both of those answers miss what's really going on. Because once you understand how money actually moves through the system, and more importantly, where it ends up, what's going on starts to make a lot more sense. So the first thing you have to understand is the stock market is not the economy. You've probably heard that before, but I don't think most people actually believe it. Because if they did, people, or at least politicians, wouldn't use the S&P 500 or the Dow Jones as a measure for how well the country is doing. There are only really three things that move the stock market: earnings, which is what companies make today; expectations on what investors think they'll make in the future; and liquidity, how much money is flowing through the system looking for somewhere to go. Now, the things that don't really have an impact on the market is your paycheck, the job market, or the price of a gallon of milk. None of those things really move the market directly, and some of those things, even though they're negative for you, they can actually push the market up. When wages stay low, companies keep more profit. When people go into debt and they spend more on their credit cards, companies like Visa and MasterCard make money on every transaction and their stock goes up. So when you ask, how can the market be at all-time highs while people are struggling? The honest answer is sometimes people struggling is exactly why the market is at all-time highs. Now, obviously, that can't go on forever because companies need customers and companies can't infinitely grow while their customers go broke. So something else has to be propping this up, and that brings us to liquidity. If you remember one word from this video, make it this one: liquidity. And all liquidity really is how much money is moving through the system. And right now, it's a lot of money. You can see it in the data. The money supply is at record levels. There are trillions of dollars sitting in money market funds, which is basically just cash that hasn't even been deployed yet. The government is still running massive deficits, spending far more than it's taking in every year through tax revenue. And the Fed, which was supposed to be tightening its balance sheet, started buying treasuries again. Reuters reported on December 10th that the FOMC approved purchases of up to $40 billion a month. All of this adds up to one thing. There's a huge amount of money in the system looking for somewhere to go, and what most people miss is that money doesn't spread evenly. For example, when that money hits the system, a lot of the time it'll go to banks first. Banks will loan that money out to corporations who reinvest in their businesses, or banks will loan it out to people who will buy homes. And eventually, you'll see some of that money flow into your wages, and people's incomes start to rise, but that takes years. Where that money flows first and where you see the impact immediately is in asset prices. Things like stocks, real estate, bonds, or crypto. And they tend to move instantly. There's a big argument to be made here too that this type of approach by the Fed actually greatly increases the wealth gap because the top 10% of Americans own over 90% of the stock market, whereas the bottom 90% own less than 7%. So when the Fed prints money and injects liquidity in the system, even if this isn't their primary intent, it still massively benefits one group of people while not doing much for another group of people. And you see the wealth gap grow even more. Now, to be fair, there's a reasonable counter argument here. Some analysts argue that the economy is actually stronger than people think and that liquidity is supporting real growth, not just asset prices. But I'm not arguing against adding liquidity to the economy. I'm trying to illustrate the point to you guys that no matter what, liquidity injected into the system flows through asset prices first before anything else. Another thing I wanted to bring up, especially about the S&P 500, is on first glance, it sounds extremely diversified because it's supposed to represent 500 companies. But right now, it's really dominated by tech stocks. There are 7 tech companies: Apple, Microsoft, Nvidia, Alphabet, Amazon, Meta, and Tesla, and they make up over a third of the entire index. And over the past decade, that concentration into tech has gotten worse. But why that matters is because a huge portion of the market's gains are coming just from those companies. In fact, an investment news article from WWM Investments found that in 2025, roughly 42% of the entire S&P 500's return came from just those 7 stocks. Capital Group reported Nvidia alone was responsible for 20% of the S&P's total return through September. That's just one stock in the entire index. So when you hear the market is up 17% this year, the economy must be doing okay, what you're actually hearing is 7 tech companies are up 27%, and it could just be the case that the other 493 are doing just okay. Now, to be fair, there are signs that this might be starting to broaden, but as of right now, if those companies stumble, the entire index feels it. So now we have 2 pieces of the puzzle: a system flooded with liquidity and a market being driven by a handful of companies. But there's one more piece, because those companies, they're not just going up randomly. There's a specific story behind it. One of the core principles of the stock market is it doesn't price for the value of a company today. It prices for what it believes the value of a company will be in the future. And the future the market is pricing in right now is AI. The biggest tech companies in the world are projected to spend between $600 and $690 billion on AI infrastructure in 2026. That's roughly double what they spent in 2025. And they're pouring hundreds of billions of dollars into AI infrastructure, things like data centers, chips, basically everything needed to scale it. And they're doing it at a level we've never seen before. And this isn't a normal investment. It's a massive bet, because all of that spending only makes sense if the revenue for it shows up later. And because these systems are incredibly expensive to build and they don't last forever, it means companies have to keep spending just to stay in the game. And to fund that, they're increasingly turning to debt. So the entire system is being built on one assumption, that the payoff for all of these things is going to come back later. Now, we've actually seen something like this before in the late 1990s, when companies poured money into internet infrastructure and they were laying fiber cables across the world because they believed the internet would change everything. And back then they were right. The internet did change everything. But between the vision of what they saw and the reality of how business works, the market actually collapsed. The Nasdaq fell nearly 80% and it took a decade to recover. Because the technology was real, but the expectations of the returns got ahead of reality. And that's the risk right now. Because right now, you have a flood of liquidity lifting asset prices, a handful of companies driving the entire market, and a narrative about AI that justifies it all. Now, how all of this connects to what I was talking about earlier, how it feels like a recession for a lot of people, even though the market is at all-time highs, is because most Americans don't own the market. The top 10% of households own the vast majority of stocks. The bottom half of the country owns almost nothing. So when the market goes up, who actually benefits? That's why this disconnect exists, because the system we just walked through, liquidity, concentration, expectation, they all push asset prices higher, but they don't push up wages the same way. And that creates a split. One part of the economy, they own the assets and they see their wealth grow. And the other part of the economy is dealing with higher costs, more debt, and slower income growth. And that's what people mean when they talk about a K-shaped economy. Now, to be fair, there's some debate about how extreme that split really is, but the direction is clear. More wealth is being driven by assets, and fewer people actually own those assets. So when you hear the market is doing great, that does not necessarily mean that people are doing great or that the economy is doing great.